Concerns have been raised that the superannuation industry didn't properly address inconsistencies in labelling of investment options within super 2 years after the regulator advocated for the move. In 2010, APRA pointed out that labels such as balanced, growth or defensive had no standard asset allocation criteria or risk descriptors. Since then, industry associations ASFA and the FSC have come up with the solution called Standard Risk Measure, but the standardisation of investment labels has not been addressed after a failed attempt to reach an agreement on this matter some time ago. Recent research conducted by Super Ratings shows a number of super funds with different names, but same splits between growth and defensive assets. Super Ratings Managing Director Jeff Bresnahan said such inconsistencies could lead to further client confusion.
I think we definitely need to standardise risk descriptors. The problem we've got is different parts of the industry interpret growth defensive assets as different ways. And we've been through this discussion probably over the last decade. ASRA at one stage ran with it very hard and unfortunately at the end of the day couldn't come to agreement with both the FSC and the AIST, being the not-for-profit and the retail areas. But definitely from a consumer's point of view, they don't care about all this in-fight or in-house squabbling. What they want to do is know that if they're in a balanced option, that a balanced option is very similar across the whole industry. At the moment, what we've got are balanced options ranging from 50% or 45% in growth assets to 85% in growth assets. And the two of them are going to behave very, very differently over a 20 or 30 year life cycle. So from a planner's perspective and also from a consumer's perspective, we do need standardisation.
Another piece of research shows balanced options currently allocate anywhere between 25 and 85% to growth assets. Bresnahan and other members of the research industry claim it is time for the regulator to step in.
The regulator definitely needs to step in at this point in time. This discussion has been going on the best part of a decade and we still don't have resolution. So what we need to do is get the regulator to say, look, this is the scale of risk associated with just about every asset class. If we can get a linear process there for trustees to work out the overall risk of their portfolio, then consumers and financial planners will be able to push that out with some degree of confidence. The other side of things is trustees will then have a greater level of liability, whereas at the moment I don't think they hold enough.
In other news, financial planners relying on volume rebates hanging around in some shape or form after FOFA could be in for a nasty surprise. And social networking, a marketing opportunity or a liability trap for advisors.